Bitcoin's the best performing asset in a decade. So it's been going up at 172% a year, every year for the past 10 years. And we had the opportunity to borrow money at 1.5% interest and invest it in something going up 170% a year.
Wow.
So obviously the arbitrage is extraordinary. And we thought, as long as we can raise cheap capital and invest it in a scarce asset, and there's an expectation of monetary inflation, it made sense for our shareholders to do that. So we eventually ended up buying about $3.1 billion of Bitcoin, and today it's worth something more like $7.5 billion.
Wow.
So we generated a $4 billion gain for our shareholders, and that was good for the stock. That drove the stock from $120 a share above $800 a share. So it generated many, many billions of dollars of shareholder value for the shareholders, and it left us with a software company that was extremely well endowed, right? And so we can go about our business of selling our software and not be concerned about the impact of inflation on our business. Now, our view is we don't want to sell the Bitcoin. Our strategy is acquire and hold Bitcoin. It's just that simple. The company has two primary business strategies. The first strategy, the P&L strategy, is we create and we sell enterprise business intelligence software. And the second strategy is a balance sheet strategy. We acquire and hold Bitcoin. And the way that we acquire the Bitcoin is partially through cash flows. The company generates a lot of cash every single year. And so we're sweeping the cash flows into Bitcoin. And then the second is on occasion, we issue equity. And if we issue equity, then we sweep the proceeds from the equity into Bitcoin. And the third would be to sell convertible debt. And when we sell the convertible debt, we use that to buy Bitcoin. And then a fourth is to sell senior secured debt, like junk bonds. We did an offering like that for $500 million in June. It was senior secured debt yielding 6 1/8% interest. And we invested that in Bitcoin. And in the future, we may do any combination of debt or equity financings or just generate more cash flow in order to acquire more Bitcoin. We also have the $7.5 billion of Bitcoin, and much of it is $6 billion or more is unpledged collateral. So we could generate yield on it with a counterparty if we want, or we could, in theory, borrow against that in the future if we wanted to. And we just consider all those possibilities. It's a function of the debt markets and the Bitcoin markets. If you look at the US dollar, it's been inflating at least 10% a year for the last decade, from 2010 to 2020. And the S&P 500 index was moving up about 10% a year during that time frame. So if you were holding dollars, if you were holding $100 million, then and you weren't invested in the S&P index, then you lost $10 million of gains every single year. Or another way to say it is the value of the cash decreased by about 10% a year. And that means over the course of 7 years, you cut your cash balance in half. Okay. What happened in March of 2020 is the inflation rate tripled. If we look at the S&P 500 index over the last 12 months, it's up 30%. I remember I was saying that the money supply expanded at 10% up until about March of 2000. But we all know that the Fed started buying lots of bonds, $120 billion of bonds every month. After that point, the interest rates got pegged at zero. The money supply expanded. And so we started inflating the money supply 3x, 3 times as fast. That means that $100 million in cash is worth $100 million, but $100 million in a stock index is worth $130 million.
Wow. At
a 30% inflation rate, that means that in about 2.5 years, you cut the value of your treasury in half. So what happened to us in March is we realized that we had $500 million, but if you cut it in half every 2.5 years, you realize that you basically burn $450 million over the decade. We're going to lose it all from the shareholder point of view. The need to find an inflation hedge became much more urgent after March of 2020. The price of everything you want to buy is going up, but the inflation rate is not a scalar. It's not a single number. I can measure the inflation on consumer assets if I want, like what's it cost to rent an average house, and what's it cost to buy a Domino's pizza? What's it cost for Netflix? Or what's it cost for canned food or cereal? That's a number. That number is normally not going up as fast. I can measure a different rate, the rate at which really good houses in the Hamptons go up in price, luxury real estate, or an Ivy League education, or if I go to a doctor not in my healthcare system, but outside of my healthcare network, or a really good dentist that doesn't take my dental insurance, that inflation rate oftentimes is 15 or 20%. I can measure the inflation rate of assets, scarce desirable assets, like stock portfolio. That's 30%. I can measure the inflation rate of a bond. Well, a bond that yields $50,000 in interest a year used to cost $1 million when the interest rate was 5%. But when the interest rates got driven down to 1%, that $1 million bond now cost $5 million.
Wow.
So the cost of an annuity, or the cost of early retirement, if you will, went up by a factor of 5. That's hyperinflation. So inflation is really a question of, it's a function of the person and what they aspire to buy. And if your aspirations are to live in your basement of your parents' home and watch YouTube and travel around by Ubers and watch Netflix and eat Domino's pizza and manufactured food, then the inflation rate is low. If you actually remove from the index the highly volatile food and energy, when we create the PCE index, it removes food and energy. If you remove food and energy and you keep the other manufactured stuff, it's even lower.
And PCE is what the Fed looks at when they measure inflation.
Oftentimes, yeah. But if you put luxury goods and elite experiences and scarce things, if you put trophy assets or stocks or bonds or commercial real estate, that inflation rate is much higher, right? We can see that the Case-Shiller index is up 27% year over year. Producer price indexes for commodities are up 20, 30, 40%. Stock portfolios up 30%. So you see, if you aspire to stay wealthy or to be wealthy, your inflation rate is not the CPI or the PCE. Your inflation rate is probably more like the return on the S&P 500 index. And so that was 10% a year for a decade, and now it's 30% a year. And so if you wish to protect your family's well-being over a long time, then you're not going to be able to invest in assets that only go up 2% a year or 5% a year. That means that most bonds that yield 3% interest have a negative real yield. It's negative 2% against the CPI or negative 3% against the CPI, but that's not really the problem. The problem is they're minus 27% against the S&P, right? So your index ought to be something more like that. If you're the CEO of a publicly traded company, you're expected to keep up with the S&P 500 index. So the inflation rate for a CEO of a public company would be the S&P index, which is 30%. So now, if you're Apple Computer and you have $100 billion in cash and you're generating 1% interest on it, and if the inflation rate's 30%, you're losing $29 billion a year in shareholder value every year. So you see, it becomes a much bigger issue for companies that have large cash positions on their balance sheet. I think Berkshire Hathaway has $150 billion of cash. So $150 billion of cash not invested in the market is a loss of 30% of that, or $37 billion, right? Some large amount of money. And it'll continue year after year. And so that's why this is coming to the forefront right now. You could ignore it. You could ignore it if you thought the inflation rate was only 2%. But when you see all these assets going up much faster than 2%, you realize there's something else going on here. And once you embrace the idea that inflation is a vector, it's not a scalar. A vector meaning there's a different inflation rate for every product you want to buy in every jurisdiction where you might be, and it's changing all the time, right? That the way you describe fluid dynamics or aerodynamics is vector calculus. You would never try to describe those things with arithmetic. You couldn't model. You can't model fluid flow around an airfoil with arithmetic. Doesn't work. So once you understand that inflation is a vector, then you start to realize that conventional remedies won't work. You can't save your money in a savings account. You can't hold simple bonds. You're going to have to find some other inflation hedge, and that leads you to look for scarce desirable assets. And the scarcest, most desirable asset in the universe is Bitcoin, because Bitcoin is digital property. It is all the benefits of gold, all the benefits of property, all the benefits of money without inflation, without friction, indestructible, immortal, move at the speed of light, programmable, and everybody wants it on Earth. And you can send it to anybody on Earth. So that makes it kind of the ideal solution in an inflationary environment.
Before we continue, help us clicking that YouTube like button and subscribe now to our channel. This shows the algorithm that you valued this information. And it helps us spread that message. Sharing is caring. And now, let's continue.
Do you want to know one thing about crypto? I made over 3,000% in profit in a few weeks. Fact is, the traditional financial system, the traditional money system makes you poor, not rich. If you want to earn $500,000, $1 million, you have to wait until you're 50, 60, 70 in the traditional financial system, and you probably will still be broke. And you will be old. This is not a sexy combination, as you can imagine. But the question is, how can you start in crypto and make these profits? Where to invest? Where to start? My name is Gunnar and I'm from Germany, as you can hear, and things are a little bit different in Germany. More about that later on. Fact is, there are lots of different cryptocurrencies. It's a gigantic universe where beginners and professionals get easily lost. But there is light at the end of the tunnel. There are 7 key steps you need to follow to become successful in this market. You have to know them, and if you fail one of them, it's literally impossible to succeed in this market. Just an example, one of the key points is your exchange, and one of the biggest are, for example, Binance and Coinbase. These are trusted and well-established exchanges, but, and this is a big but, you won't find the super profitable coins on those exchanges. The unknown super profitable coins that get gigantic profits are not traded on those kind of exchanges. They are traded on much smaller insider platforms that are barely known. And I can tell you what those super secret exchanges are and why they are so profitable. And another super important thing are the right information sources. The point is, the internet is gigantic. There are hundreds and hundreds of YouTube channels, blogs, pages, and much more. And there are also market makers and influencers. For example, Elon Musk, he is not a crypto guy, but the moment he recommended Dogecoin, it went through the roof, to the moon, so to say. But why did he recommend it? Where did he hear it from? He didn't hear it from newspapers. And believe me, he is listening to someone. But you have to know who, and you have to react before he is reacting. This is really, really important. And these are only 2 of the 7 steps you have to follow in order to be successful in crypto. And if you want to know all of these steps in much more detail, and if you want to have a comprehensive checklist, here's what you should do. There is a link below this video. Click on this link and you will get the opportunity to subscribe to my channel. Click on the link and you will see a video where I explain the next steps. So see you soon. Click on the link now. I'll see you there.